thanks to Ernie and to the organizers for inviting me to speak on this topic. It's a really interesting topic, but what started worrying me was that given the performance of my economist colleagues at predicting the financial crisis and providing advice for all that stuff, I thought, boy, maybe Ernie's going to uninvite me, given how well we've done on some of that front. I'm going to present the conclusions, which actually I don't think are all that. Oh, I can use that. Thank you. All that different from the last presentation, and let me say why. I think in my world, the economic world, we're starting to see an increased interest in natural capital, and natural capital really being recognized as part of overall wealth. And I'll try to show you some attempts that people are doing to incorporate natural capital into wealth and to actually try to measure depreciation or whether we are actually overspending in various categories, and we'll find out that we are in some. Preston Manning did such a nice job this morning of actually covering what, at least on one of those things I was going to talk about when he described this notion of gross national waste. I love that phrase. Folks are trying to do this, and I'll present you with a couple of pieces of evidence. Not perfect, but an attempt on that front. This notion of ecosystem services is actually showing us that there is a link between what's going on in nature and what consumption bundles or things that we like to enjoy are, and the quality and quantity of those will change if we affect nature in adverse ways. So that recognition provides us a link between the economy and the environment. Now, we've made some strides in valuing ecosystem services or in trying to assess what the value of natural capital is. We're not perfect at it, and so certainly improved information would help on that front. That's come up in the report this morning. Preston raised that as well. But I've spent a long 25 years trying to figure out the value of environmental goods and services, and while I certainly believe that's important, I think we also have to, at the same time, not wait for the values, because they're hard to measure in many cases. We'll have to start thinking about actions to avoid irreversible loss, and that's this last point. What can we actually start doing to guide reinvestment? And I use the buzzword efficient resource use, but efficient resource use may well mean carbon taxes. If that's an adverse effect on the environment, to not price that appropriately is an inefficient resource use. It may also mean rewarding the provision of ecosystem goods and services, providing payments for environmental services. And I think integrating economy and environment in this way is really important. And for me, that's a vision of stewardship. That's a vision of collective stewardship that goes beyond what we as individuals should do. And I think it's interesting that cigarette taxes came up in the last presentation, and it is true that we try to tax bad things. Well, we should continue that. We should continue to push that on the front of adverse environmental impacts. Flip side, reward the provision of environmental goods and services and rethink the way that we link the environment and economy. Okay, so now you can go and have a nap, because that's really all I'm going to say. The rest of this is just filler. I used to teach a class at about 1:30, and students had this habit of falling asleep, especially those in the back row. So we'll see if I can avoid having you do that. Okay, I'm going to flip through some of these very quickly because I think they're words. Let me give you the framework. So here's the sort of standard framework that we think of in economics when we think of where natural capital fits with all other forms of capital. This graph, physical capital is all this infrastructure stuff that we have around, the things that we build. Human capital is what we invest in our thinking and our processes and education. Natural capital, I've just drawn an arrow in there. Historically, we've been drawing down natural capital, whether it's energy resources or ecosystem services. We've been substituting those for these other types of capital. Now, one of the notions that can get us in trouble is this notion that all of these are perfect substitutes, that we can just move everything out of one box into another box. And we might be able to do that to a certain extent. We could take energy resources and reinvest them into human capital. But there are some points, irreversible outcomes, for example, we want to avoid. And so we tend to try to separate components that we think of as strong sustainability requirements, in other words, don't deplete the natural capital, versus weak ones, where we could move from one category to another. I'm going to skip that. This is one of the attempts that's been made in the last couple of decades to actually try to measure these changes in natural capital. And it's not the actual capital stocks, but measurements of whether we're investing or depreciating these various stocks. And I'll show you a picture on how this works. This is a concept called genuine savings. So we take the annual investment in physical infrastructure, the net savings in various kinds of accounts. That's a plus. I've just labeled it as a plus for this case. We're going to add to that our investment in human capital. That's a good thing, right? Especially for me, coming from a university, I'm happy people are willing to invest in human capital. So we're going to put resources into that. That's adding to our capital stock. We're subtracting capital stocks from energy resources, in particular, forestry if there are net changes, from mining. So these are depletions that we have to account for. Now, we can't just continue to treat energy resources as incomes. They're really offsetting capital stocks. And in the long run, if we're going to try to maintain a net level of capital, we're going to have to offset those by investments elsewhere. CO2 emissions. That's a depreciation to a particular set of environmental services that, again, we have to account for. And I've added this one, air pollution. The reason I picked this particular set is that this is a set that's actually being quantified and measured at a global scale to try to assess how economies are doing. Add them all up, and in this particular picture, the genuine savings happens to be negative, which would, for any particular economy, indicate that we are depreciating natural capital. And in fact, this is a kind of sustainability indicator, emanates out of the World Bank Economics Unit, but it's one of the measuring sticks that we're trying to use. All of these, I should point out, are being measured in common monetary units. That's a bit frightening at times, but I think the progress we've made is, at least for some of these categories, we've been saying, let's put them all in the same units, and let's see how the pluses and minuses add up. Now, that's Canada. Short time series, we haven't been measuring this for a long time. The overall trend doesn't look so great. A lot of that has come from energy resources, and the fact that that bank account is being reduced. Some of it comes from CO2, some of it comes from investment in human capital, but the positive side, I guess, is that we're still above zero, that there's over time been a positive reinvestment of some form throughout the time period. It would be really interesting to see how these next 2 years shape up on that graph. I'm not sure it'll be quite so rosy. So where do we fit? Sorry about changing the colors here. We're kind of in the middle of that set of lines. Now you can see there, surprisingly, there are a few parts of the world that are way up there in the plus 20% net category. So all these things added together. But I thought I'd show this one just to put a little bit of international perspective on this issue. Look at that green line on the bottom. That's sub-Saharan Africa. They've been negative over this entire time span. And all the assessments of global sustainability point at regions like sub-Saharan Africa as simply not being sustainable. They're not investing in any of these areas, and we're not helping them, frankly. So I think that's worth keeping in mind, that we might not be performing wonderfully. There are other parts of the world that are really suffering on these sustainability indexes. So what's genuine savings good for? Well, it helps us at least recognize that natural capital, or some forms of it, are linked into general economic progress. We've got some components that we can measure and implement well, but it assumes this perfect substitution, and we're missing a bunch of chunks. What are we missing? Most of the things that we're interested in this forum. We don't have good valuation tools, at least not confident enough to be able to incorporate them into those genuine savings categories. We're likely, once we go recreation. Why are these things so tough to assess? Well, they're complex. It's not just economics, it's understanding the biophysical linkages between a change in natural capital, a change in the environmental services, a change in the value systems, or the values that people are expressing, and their public goods. Public goods immediately means there aren't markets, or they're not well-functioning markets. They're likely underprovided, because there's no market functioning indicating their scarcity, which also means they're likely underinvested. Two short case studies. So recreation and tourism. Let's look at a couple of interesting trends and see whether we can uncover whether it's changes in ecosystem services that are driving these trends, or other factors, or both, and then we'll look briefly at boreal caribou. This is a trend, actually a pretty interesting paper a couple of years ago that came out and started quite a dialogue. These are per capita visitation rates at a variety of outdoor recreation tourism sites, mostly in the US but elsewhere. Since about the mid-'80s, per capita participation in tourism and outdoor recreation has been declining.